Figma is moving forward with its IPO. We'll look at S-1 highlights and preview what comes next. In IPO Radar news, Climeworks raises funds, Anthropic's accelerated revenue growth, and Perplexity is fending off 2 Mag 7 suitors. Welcome to the Access IPOs podcast, where we explore opportunities to invest in the world's most innovative and disruptive pre-IPO companies. I'm Craig Stevens, founder of Access IPOs, and July 1st we got our first second half IPO. It's Figma. The Figma IPO is now expected toward the end of July or early August. And just last week, we highlighted our top 10 upcoming IPOs for the second half, and Figma was number 4 on that list, but sure seems like they were ready to move forward with this deal. The S-1 filing is pristine. It's one of the tidiest S-1s I've ever seen, probably the nicest S-1, the easiest to read. A brief timeline leading up to this deal. Remember back in 2023 in December, Figma and Adobe had to break off their merger plans due to regulatory worries. I expected Figma to remain private and eventually move toward an IPO, but it happened faster than I thought it was going to happen. In March this year, we got a report that said that Figma was talking to banks. And then just a month later, on April 15th, Figma announced that they had filed confidentially for an IPO, and exactly 2.5 months later, the IPO was released to the public. That's a faster timeline than we usually see, about 2.5 months. Figma clearly had its ducks in a row. We also got a report in May that said that they hired Morgan Stanley, which usually that story comes earlier in the process, usually before the confidential filing, but I guess they kept it under pretty tight wraps there for a while. In terms of the look and feel of this S-1, Figma is a design company, so it's nice to see that they wanted to represent their brand and their culture in the S-1, and of course the S-1 takes on SEC government format, and they're usually pretty ugly, and they're broken up onto a web page. And usually I take the URL and I put it into a PDF just to make it easier to read on my website. I didn't need to do that with this company. You just click to the SEC website, and it's a perfectly formatted S-1 filing, at least on desktop. So I'm going to walk through the S-1 here briefly and just highlighting some of the things that stood out to me beyond just the nice format of it. Then I'll walk through what to expect to come next, what's going to happen next with this filing. And I'll throw out some potential IPO dates and how I'm going to approach my investment strategy going into the Figma IPO. I'm sharing my screen if you're listening audio only. We're looking at the Figma S-1. So remember, we get these initial releases of the S-1, and it comes with financials, but it doesn't come with terms. And all the blank spaces you see will fill in when they amend the filing, and we'll talk about that in a little bit. The stock's going to trade on the NYSE. The stock symbol is FIG, F-I-G. And underwriters, Morgan Stanley, Goldman Sachs. Now, this is turning into a broken record. Morgan Stanley has been the most aggressive of these underwriters moving forward with IPOs. And it almost seems like some of the other banks are falling behind. They haven't been prepared, but Morgan Stanley seems to have anticipated this IPO window that's open, and several of its deals have done quite well. JP Morgan's involved, Allen & Company getting a spot before JP Morgan, but Morgan Stanley, Goldman Sachs, JP Morgan have been really involved with all of these deals that we've seen, or most of the deals we've seen come through this year. Figma likes to show off that a lot of big names are using their design software, Netflix being a big one, Duolingo they reference a lot in this S-1. So a lot of information about how people use it. And in fact, they even show you how a team would go through the design process with it. So it's more than just financials in the company. It's really digging into the software itself and showing you how this is used by companies around the world. So first thing I want to highlight is the founder's letter coming from the founder, Dylan Field. In this prospectus, I'm excited to share more about Figma with you as we begin our transition into public markets. Given the trend of many amazing companies staying private indefinitely, you might be wondering why I've decided to take Figma public in the first place. So cool to see him respond to the other companies out there who are choosing to stay public. He goes on to say some of the obvious benefits include corporate hygiene, brand awareness, liquidity, stronger currency, and access to capital markets. More importantly, I like the idea of our community sharing in the ownership of Figma, and the best way to accomplish this is through public markets. This is what I talk about all the time on the podcast. We want to see companies that want to bring their customers in as shareholders. Customers make better shareholders than Wall Street bankers or wealthy clients at Morgan Stanley. So why not let your designers and the people that use your software be part of the company and give them IPO access? We're not seeing IPO access for customers. That may be kind of difficult because it's a corporate customers and then a bunch of users. So they're not going to give IPO access to users. But we do see a desire here to offer an ownership opportunity to the community, which would be the designers who use the software, and a lot of that in the corporate environment. So I don't anticipate seeing a directed share program for users of the software, but I do think maybe this is a hint that they may somehow get shares delivered to retail investors through a Robinhood or a SoFi. We'll talk about that in a little bit more. He also makes a point to talk about AI and how they're investing in AI and how they want to be aggressive with acquisitions, especially in the context of AI. So nice letter from Dylan Field here, especially because he's doing this in part, or he says most importantly, so that his community of designers can be investors as well. A couple quick stats here: 13 million monthly active users. 2/3 are not designers. 95% of Fortune 500 companies use Figma, and 78% of Forbes 2000 companies. I've never heard of Forbes 2000, but that's a lot of users and a lot of deep pockets of those people paying for the software. And it shows in this net dollar retention rate. That 132% net retention rate means the company can grow revenue from existing customers by 32% without acquiring new customers. This is exceptionally strong, indicating low churn, high customer satisfaction, successful upselling and expansion, and a strong product market fit. There's also a 46% year-over-year revenue growth. Wall Street loves to see that, especially with a SaaS. Remember, this is a SaaS company, software as a service. I'm not a SaaS expert, but analysts of SaaS companies have very well developed metrics that they follow, and revenue is certainly one of them. Net dollar retention rate, certainly another one. So these are highlighted for a reason, and it could lead to strong demand. We'll get more in the IPO Roadshow, which, by the way, will be a very well-designed document, I'm sure. And we should be getting that in a few weeks. So as I was reading through this, I was just interested to see how the teams use this software and how it improves design and how it improves the process and how it facilitates the brainstorming to design to development to shipping software. It just streamlines that whole workflow. Goes into total addressable market. I'm not really that interested in total addressable market. I think that's always inflated. You can scroll through this part of the S-1. It shows Duolingo and how they use the product. This is a design company. They are good at telling stories, and that's exactly what this S-1 does. Beyond what a typical S-1 would do when we're just talking about financials, this talks about the use case and why companies are paying for the software and why teams love it. Here's a quick view of the financials. The main thing I look for is revenue growth, and you can look at it by quarter, but I'm looking at year over year. We have 2024 revenue at about $750 million, and revenue for 2023 was $504 million. So I think I said it was a 46% year over year increase. That's really extraordinary. There are some losses, and I didn't read into why there was a net profit in 23 and a net loss in 24. Something I should dig into a little deeper before the podcast. I didn't. That's something to look at if you're thinking about investing in this deal. Why did they lose money in 2024 versus 2023? Probably has something to do with investing in growth. I think it's notable that this company has about $1.5 billion in cash and cash equivalents on the balance sheet. They are likely raising money going into this IPO, but according to that number, they don't really need it. But I do think they'll use this opportunity to raise money. But a strong balance sheet is what we want to see going into a deal. If this is a $20 billion company, and I say $20 billion because that's what the pre-IPO marketplace data tells me. It's about a $20 billion deal. Also, the Adobe deal was around $20 billion. So that's what we're expecting to see. And 1.5 of that being cash equivalent, that's a nice sign. It does have some debt as well, so take a look at that before you invest. A couple nice charts here. Paid customers with more than $10,000 in annual recurring revenue. As of March 31st, 2025, they have 11,107, and that's up from just 10,517 at the end of December 2024. So when they charge customers, their business model, they charge per seat and they charge per service within the software. Here's another chart with paid customers paying more than $100,000 in annual recurring revenue. I would assume Netflix is one of these, Duolingo. And that number is growing very nicely from March 31st, 2023 to March 31st, 2025, going from 456 customers to more than a double, 1,031. So we have some very nice, clear charts here giving us important information about customer growth. Those are retained customers who are growing their spend. So this company is growing without even bringing on new customers. Another chart about net dollar retention rate. And one more nice chart here, annual recurring revenue by annual cohort through March 31st, 2021. It's showing when a new customer is acquired, their spend tends to increase over time. So that's a story they're really trying to tell. Now, if they've already gotten into 95% of the Fortune 500 companies, you can see why they'd be touting this growth within existing customers, because it kind of tells you that maybe there's not a whole lot of customers left who are going to be using the software in the Fortune 500. Of course, there's a lot more companies than that globally, and organizations, nonprofits, etc. One last thing I noticed in this filing, and I don't usually see this, or at least I don't notice it, but Figma has a small venture arm, and in April 2022, they entered into a Series A agreement with a company called StackBlitz, where they invested about $200,000 in StackBlitz along Greylock Partners. So interesting to see them disclosing this little venture investment. So what should we expect to happen next with the Figma IPO? After the S-1 filing is released to the public, the issuer, the underwriters, they let it simmer for a little bit. Usually give it 3 weeks or so, sometimes longer. In fact, Klarna and StubHub we're still waiting on those to get updated. So once it's released to the public, investors have a few weeks to peruse the S-1 filing, and it's long. It's a couple hundred pages or more. The next thing to look out for is updated terms. And the updated terms come via an amended S-1 filing. You can go to my S-1 filing feed on the website, top menu, look for the link that says S-1 filing, and that's where the SEC filings actually come onto my website. You can also go to the SEC website and just search for Figma, or you can go to a search on forms and look up S-1s, and when the form drops, it'll be there. And when that filing is released, I will let everybody know on the website and through the newsletter. And that updated filing will contain the offering, how many shares they're offering in the deal, and any details of those shares, if, for example, some of the founders or early investors are going to sell shares in the IPO. So they tell us the number of shares that they're offering, and then the price range, an initial price range, which is usually somewhere in the range of $4 or so, $32 to $35, something like that. They let that price simmer for about 7 to 10 days. And when that amended filing comes out, that's when the IPO Roadshow starts. You go to retailroadshow.com. There'll be a PDF and a presentation by leadership. You can start to evaluate the pricing of the deal. Underwriters go out and they gauge interest in the deal and gauge demand and determine if that price is appropriate. They've already done a lot of work on that to get to evaluation, to get to that initial price range. They release that to the investment community. They then modify the price the night before the IPO and come up with a final IPO price. So amended filing, I'd say probably the week of July 21st or 28th. And then whenever that filing is submitted to the SEC and we can see it publicly, that's when the brokers start offering the chance to request shares and try to get an allocation. As I mentioned, I think Robinhood and SoFi have a pretty good shot at this because of the statements by Dylan Field that he wants his community to be able to invest. And since there isn't a directed share program, at least not in the initial filing, there could be one in the amended filing. And so we'll be watching that. If they're not doing a directed share program for customers, then we hope to see a decent allocation going to Robinhood or SoFi. Fidelity, good chance they'll get some shares. How many they get, though, we don't know, and their wealthier clients are going to get access to the deal before their non-wealthy clients like me. I've got enough to get an occasional allocation, and that's how I got the Circle allocation. Fidelity apparently had more Circle shares than they get from a lot of other IPOs. Other potential brokers that'll have access is Webull. Webull gets a lot of deals. They got Circle shares. I'm going to try to get shares on Webull, Robinhood, and Fidelity and see what happens. If I can get IPO shares at the IPO price, I'll invest in the deal. If I can't get in at the IPO price, then I'm not going to invest. That's just my strategy. That's where I'm trying to take advantage of that deliberate underpricing of the IPO by the underwriters to induce that pop at the open and a perceived successful IPO. So if I can get in at that IPO price, I'll invest. If not, I don't invest. I'm not a trader. So once this thing opens, I don't know what happens. That's up to the traders, right? I'm looking for that arbitrage opportunity. A few tips if you're trying to access IPO shares in this deal. First of all, you want to have money deposited and cleared in the brokerage account where you intend to request shares. Webull especially, they won't let you request shares unless you have cleared funds available. You can't wait for it to show up and then deposit a bunch of money and hope to get an allocation. You have to have the money there and cleared. Robinhood and SoFi are a little bit different. When the IPO drops to the brokers and they start offering shares to customers, you can deposit money that day and then make the request. There may be some limitations on how much they'll allow for an instant transfer, but they're a little more flexible. But the best practice is to have money in the account and cleared and ready to go. The second thing you need to do is request more shares than you actually want to invest. And this might be a little scary because let's say you want to try to get $1,000 worth of shares. You may need to request $10,000 worth of shares to try to get that $1,000. That's how Robinhood works. The bigger your request, the more likely you are to get more shares. The recent example is Circle. Robinhood investors typically got somewhere in the range of 11 to 16% of their requested allocation. And that's the same if you request $1,000 worth of shares or $10,000 worth of shares. So if you request 1,000, you may only get 10% of that, and that's $100 worth of shares. During the Circle IPO, one of our community members in the Access Club requested 1,000 shares of Circle, and he got about 109. So you have to be willing to put up that big number to try to get a reasonable number of shares. I requested 300 at Fidelity, and I got 100. It really varies on the deal. We don't know how many shares any of these brokers are going to get allocated, if they get allocated any shares at all. And we also don't know how many investors are going to request shares. And then each of these companies has their own proprietary way of delivering allocations to investors. But the best practice, have money ready in the account and cleared, request early and request higher than the number of shares you want to invest in. If you don't get shares, that's normal. We often don't get shares, and it can be frustrating. But typically when we get shares, the price of these high demand IPOs often goes up immediately after the IPO. And when you lock in that arbitrage profit, that makes up for the deals that you don't get access to. And that's just the way IPO investing works. The one risk you have to watch out for is if you request a lot of shares of a deal and it's a low demand deal, then you might get a lot of those shares. And if it's a low demand deal, it may not open higher. And that's a risk we take. So just beware that this is not a guaranteed pop on all IPOs. Now, when the window's open and IPOs are more receptive, yeah, there's a better chance that the IPOs are going to pop. But Venture Global earlier this year was supposed to be this blockbuster IPO, and it opened down, and I had shares, and I lost some money on that. But my Circle IPO performance made up for it. So it's a risk we take. Let's move on to IPO Radar news. This is when we talk about news in the context of the companies that we follow on our IPO Radar list. And there's about 150 of them. And I have Google Alerts set up, and I follow all these people on social media. And I work really, really hard to aggregate all the news out there and update my website every week when there's a news story that is applicable to one of these companies that I've written about in the past, an IPO Radar company. So our first IPO Radar story is Climeworks. Climeworks is a Switzerland-based carbon capture and storage company, and they're the leading company in this space. This is a technology that essentially filters the Earth's air and extracts carbon, which is sort of doing the opposite of what a car does. It's almost doing what a tree does. A tree takes out carbon dioxide and puts oxygen into the atmosphere. Carbon capture and storage, or sequestration, is an important technology in the big picture of climate change and reversing the effects of climate change and carbon release into the atmosphere. Now, it's not the only solution, and it may not be the best solution, and I actually question the business model a bit. But the story here is that Climeworks raised $162 million in equity financing. The funding will accelerate innovation, lower costs, and expand Climeworks' CO2 removal platform, which already holds over 6 million tons of secured supply. Climeworks is a global leader in direct air capture, DAC, and carbon removal solutions, and it has raised now more than $1 billion, this equity raise of $162 million, so over $1 billion. Now, I was looking at Caplight, and this company raised a Series E in April 2022 at a 1.1 post-money valuation, and now they've raised another $162 million, and they don't really say what the new valuation is. I haven't at least come across that data yet. So this company may be turning into a bit of a zombie. It's raised $1 billion. It's worth $1.1 billion, maybe more. We don't know until we get an updated number on that value. The problem I have with this business model, first of all, I really like this technology. I think it's an important technology for the long-term future of our Earth. I mean, there's a lot of different ways we can solve climate change problems. I believe it's a problem. The problem I have is that this company is going to rely on government policy. It's going to rely on possibly subsidies and voluntary compliance. And those are not the types of things that, to me, fuel a growth business. So while I like the technology and it's an important technology for climate change, as a business, I'm not super excited about Climeworks. It's a Swiss company, operates under different regulations. So not a super exciting company from a potential investment standpoint, but it is an exciting company from an environmental, long-term carbon perspective. And if this company can perfect its technology and scale, I think there is a business there for it, and there's certainly a use case, but ideally we want to stop carbon emissions before it happens. And so that's where nuclear and fusion technologies are hopefully going to reduce the carbon output in the next few decades. Climeworks raised $162 million. Good to see that one at least raise some money and continue to grow. Next up is Anthropic. Anthropic has always been the number 2 to OpenAI. And you might even call it a number 3 once XAI came into play. But I've been following Anthropic for quite a long time. Anthropic's an LLM, a large language model company that has Claude. And Claude is known for being one of the top LLMs out there. It's especially good at coding. And so the various vibe coding companies use Claude to help with coding. It's got top tier leadership and AI scientists. 2 things I want to point out this week is that Anthropic is going through accelerated revenue growth. Back in December, there was a report indicating the company had hit $1 billion in annualized recurring revenue. There was an article on May 30th, a Reuters article, that said Anthropic hits $3 billion in annualized recurring revenue. And then July 1st, we got another article that's 32 days later that said Anthropic revenue has hit $4 billion in annualized recurring revenue. This is extraordinary growth. If you think back to a few months ago, I think we heard, maybe just a month or 2 ago, we heard OpenAI is at $10 billion annualized recurring revenue. That's exciting growth, and it's reflected now in Anthropic's private market valuation. Earlier this year, Anthropic was raising money at a $60 billion valuation. That was a Series E. It looks like that closed in March. And now I'm looking at Caplight, and the current estimated valuation is $95.1 billion. And this is just July after we were at $62 billion in March. Extraordinary growth for this company. The risk with these AI companies is that, yeah, the revenue is incredible, but how are they going to become profitable? They're a long way from it. The cost to hire talent, to run these models on chips, they need to have servers and server farms and chips, and just the cost and the energy required to run these LLMs is extraordinary, in the billions. These companies have to keep raising money. We saw OpenAI raised something like $40 billion. I think they started with 10. They're going to be raising more and more in equity financing. They're going to need some debt financing. I'm showing a chart on my screen. It's Caplight, just showing the value growth from October of 2022. This was about a $4.4 billion company. It's now $100 billion. Extraordinary revenue growth, and I guess we're going to see this continuing to go up if it's already accelerating from $3 to $4 billion that quickly. By the end of the year, we could be at 10. There was an article back in February 12th, again from the information. They must have a source there. Anthropic growth is expected to be $34.5 billion in 2027. I don't know if I believe that. That's a huge number. If that's true, that's a 10x from here. It's going to be approaching a $1 trillion company by 2027. That's hard to believe. Best case scenario, if the economy keeps growing and there's no recession, stock market hits all-time highs between now and 2027. No doubt they have an excellent business. No doubt they have excellent technology. No doubt that AI is changing business and individual lives. Extraordinary technology that's going to do incredible things. Will this be a $1 trillion company by 2027? That seems like a stretch to me. But can't deny what's happening with Anthropic's revenue growth right now. And you got to think that some of their engineers are being approached by these other companies who are trying to hire away talent. Meta has been in the news for that recently. And our next story is going to highlight a bit of what's going on with Meta. So our last story highlights Perplexity, perplexity.ai. If you've never used it, it's a Google search alternative, and it does a really nice job of search. They're building out a finance platform. They're building out deep inquiries where you can ask harder questions and it'll figure things out. And it taps into these other LLMs. As I understand, it taps into OpenAI, taps into Claude, LetChat, and others to improve the search experience. And Google should be worried. It's a better experience. And who knows what what Google's doing. Their Gemini is happening, but they also have these AI overviews, which a lot of people just find them to be annoying. They don't source material as well as Perplexity does. And just the interface is getting tired. Perplexity does a really nice job. These other companies, the Mag 7s, are taking note. So I learned on June 20th that Meta had discussed buying Perplexity before buying Scale AI, and it didn't buy Scale AI. Facebook, Meta, bought a 49% stake in Scale AI, and they hired away their CEO, which we talked about a few episodes ago. So I got this story about Meta trying to buy Perplexity, but I totally missed another story from Bloomberg on the same day, June 20th, that Apple execs have held internal talks about buying AI startup Perplexity. Perplexity now has two Mag 7 companies who are paying attention. Google, probably not going to care too much. Google is trying to fend off Perplexity and defend their turf. They have still a 90% market share of search. If Apple were to take over Perplexity, that would really change the game because they have their iPhone distribution network. We learned that Google paid Apple for years to be the default search engine for Apple iPhones, and I think they got into trouble over that. They have to now offer a choice. If Apple were to buy Perplexity and build that into the iPhone, that could be certainly an antitrust problem. If Apple were going to try to do that, the regulators may step in, but it could be a real problem for Google if Perplexity is built into the iPhones more because iPhone users use Google. Now, this is just executives at Apple talking about buying Perplexity. Perplexity did respond to the article saying we have no knowledge of any current or future M&A discussions involving Perplexity. The AI startup said in the statement. Apple declined to comment. So you have somehow a reporter figured out that some executives were talking about buying Perplexity. And this is significant because Apple just doesn't make acquisitions, big ones like this. Apple acquired Beats headphones, and that was in their sphere of competence where Apple's a device company, so they bought a device maker. They didn't have to go out and build premium headphones. Perplexity is at least a $14 to $18 billion company. If Apple were to make a play here, it'd be a big number. This article and others throw out that $14 billion valuation number that we've seen from Perplexity. There was a Bloomberg report in March that said it's about an $18 billion company. If Apple and Meta are vying over this company and Perplexity declined Meta and Meta went and bought Scale AI, it had increased valuation. If Apple really is looking to this company, it's going to boost the value of Perplexity and could really change the game in terms of search on mobile devices. Perplexity is not just focused on search. They've got other businesses happening with a finance tool that's paid, and they really seem to be moving ahead with new features. They were even talking about trying to acquire TikTok. So the way they're operating, it sounds to me like they want to remain a private company. They seem to have rejected Meta, or at least fended them off. If Apple comes knocking at your door and throwing big numbers, maybe a $30 or $40 billion number, that's going to be a hard one to turn down. Apple is the premium company in the world. Now, in the past, I have talked about how I don't like seeing these Mag 7s coming in and taking over these growth companies. Wiz was a big example. Google bought Wiz for $32 billion. The Scale AI story with Facebook was another one. I didn't like seeing that. I'd rather see these companies remain independent. Scale AI wasn't a total takeover. It was about half. They're claiming to be independent after that, but we know that's not true, and customers are abandoning Scale AI for Surge AI, which is one that's not on our radar, but maybe needs to be soon. So I don't like seeing these Mag 7s take over these high growth companies, but in Apple's case, might be a little bit different because of the way that Apple is so careful about their acquisitions. They don't really make acquisitions, and how it could fit so well into the Apple ecosystem. And I feel like Perplexity has almost an ethos approaching Apple in the way that they've grown and operated. It's got an excellent brand name, and it's a really wonderful user experience. Give it a try, perplexity.ai, if you haven't yet. So normally I don't want to see a big company take over a small company like this, but Apple, I am an Apple shareholder. I'm a long-term Apple shareholder, and if you're going to look for a buyer out there, Apple was probably the highest tier buyer you could possibly have acquire your company. And if they throw out the right price, Perplexity's investors may encourage leadership to take the deal. And Perplexity has a lot of investors. NVIDIA is one of them. Jeff Bezos, Bezos Expeditions, Bessemer, Nat Friedman, Databricks has a piece of Perplexity. A lot of individual investors, SoftBank's in there. So this is a very high-profile company that has some very high-profile suitors. I wouldn't be surprised to see a deal go through, but my gut tells me Apple's not going to buy this one, even though that rumor is churning. Seems like Meta missed the mark and they're going to be building out their own superintelligence. But Perplexity, I think, has a better business than just building AGI or superintelligence. Perplexity is search, and that's a well-known business model that works. Google search has been flailing, and I think Google should be worried about Perplexity, whether or not Apple buys them. If Apple buys them, then that, I think, really puts Google at risk, because then you have that firepower and that money that Apple has, and it makes for a more even matchup, Apple versus Google versus Perplexity versus Google. It's going to be very hard for Perplexity to take market share from Google because it's just not nearly the size of Google. It's just a much smaller player. Sometimes small companies can be disruptive, but sometimes they need some help from another large player, and Apple could play that role. That's all for the show today. If you like what you're seeing in this podcast, this is episode 18. Please hit that subscribe button wherever you consume your podcast or video. Subscribe, follow, like, whatever it takes. And if you have an extra couple seconds, just tap that star and give it a 5-star rating. It's very easy to do. You don't have to write a review. Just click that 5-star review, and it'll help the show grow. It'll help get in front of more listeners. You can also subscribe to the Access IPOs newsletter. That's a weekly email that comes out on Sunday morning, just once a week, and it's not too long. The newsletter is a reminder that the podcast is out there, and it gives you a brief overview of the podcast if you don't have the time to listen to the whole thing. There's some bullet points. Hey, here's what the podcast is about. It also highlights IPO Radar stories that don't make the podcast, and I usually write a new article once a week covering a new company, bringing another new IPO Radar company under my wing. And finally, if you want to take your IPO and pre-IPO investing to the next level, join the Access Club. That's our Patreon membership group, which is growing. We have some new members joining recently. That's where I share weekly curated news. I share investment opportunities in the pre-IPO space, comparing different availability across various platforms. I also get input from members about what companies to bring under the radar. Just today, I wrote a piece about my Figma IPO game plan, how I'm going to play it, and the details are all written in there. So if you want to take your investing in IPOs and pre-IPO companies to the next level, join the Access Club. Go to patreon.com/accessipos or go to accessipos.com and look for the red star in the menu. Thanks for tuning in this week. I'm Craig from accessipos.com. Thanks for listening. Thanks for watching, and I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.